think I saw the price of Bitcoin again, and I was like, whoa, this thing just went 10x in just a few years. And so I'm like, I've covered stocks enough to know that sometimes when something does a 10x, it means there is something to it, not that it's a bubble. Like most people, I think, tend to think if something's gone up a lot, it's a bubble. But actually, in the equity world, a lot of times it's actually telling you something's real.
In this recent interview on Raoul Pal, the Journeyman with Tom Lee, we learn about Bitcoin's explosive potential for 2025, the transformative power of AI on the economy, and the key demographic shifts driving the next equity bull market. Tom shares his insights on why Bitcoin remains his top investment idea, explains how AI will reshape productivity and capital allocation, and reveals the demographic factors that could fuel unprecedented economic growth. Before we begin this discussion, don't forget to like, subscribe, and share this channel. Now, let's hear more from Tom Lee.
That's right. And so, of course, guys like Warren Buffett did famously well, but it shows you like there's a generational scar. And I think that post.com, Gen X was generationally scarred, which is why hedge funds did very well in the 2000s, but retail investors didn't buy stocks. And then, like you're saying, 2020 is when the first millennials were in their 30s. 1980, yeah. So they'd be like in their 30s by that point. And they're the ones that suddenly discovered equities. Bitcoin actually had come up in several discussions when I was at JP Morgan. And John Normand, who was the head of FX at the time, had talked about it. He wrote several pieces about. He wrote one that we had a whole conversation around, our firm did, which is that he thought that Bitcoin could become a currency at some point. Now, I think the network value of Bitcoin was like 20 billion, okay? Which made it like a decent sized stock. But he was saying that it was obviously mostly for dark web and, illicit purposes. So I didn't think much of it, and I didn't even follow Bitcoin. But then we started Fundstrat. And then in 2017, I remember just for some reason, I think I saw the price of Bitcoin again, and I was like, whoa, this thing just went 10x in just a few years. And so I'm like, I've covered stocks enough to know that sometimes when something does a 10x, it means there is something to it, not that it's a bubble. Like most people, I think, tend to think if something's gone up a lot, it's a bubble. But actually, in the equity world, a lot of times it's actually telling you something's real. With our not great understanding, we did spend about 4 months doing a research white paper on Bitcoin. It's exactly what you said. First, we found that if you just did a very simple two-factor model, which is the number of wallets and then activity per wallet, it explained over 90% of the rise of Bitcoin. And then, we realized that's exactly why social media networks created value. Because, I mean, the idea of like eyeballs and someone being the customer, and then because it's free and you sell them out, like that was a very new concept. So to me, I had already believed in this idea that you could create businesses digitally that didn't start with a factory. And so we published our first report on Bitcoin. It was around $1,000 though. But we said that by using the same two-factor model by 2022, it could be $25,000. And that was either saying it was going to be worth 10% of gold or the number of wallets were going to increase. I don't remember the whatever assumptions we used. And then when we published at the time, I did it more as like a thought piece. And of course, I was advocating for Bitcoin. We recommended 2%, but it wasn't something that we thought we would hang our reputation on. But it created immediate backlash for us with our institutional client, who became very angry that we were trying to pitch something that had no tangible value and was clearly just used. I mean, I think the story arcs are pretty bullish right now. From the shorter lens, this incoming administration, I think, is doing things that look very disruptive at the moment, but I think structurally are really positive because it's a path for U.S. deficit to normalize, and I think Indeed, I think animal spirits are coming back, even though things like these consumer confidence reports don't show it. And we know that there is tangible drivers of productivity, including AI, in front of us, that justify investors allocating capital. And of course, there's still plenty of disruption ahead, including crypto. And I think Bitcoin is still our favorite idea for this year. So we think it'll be the best performing asset class, even better than gold. But I think anchoring all of this is a demographic story. I can send you some charts later, but if we look at the number of people aged 30 to 50 in the US, that's actually been steadily rising since 2018. Since 2009. It actually went positive in 2016. And what I mean by that is the number of people aged 30 to 50 matters in an economy because they're the ones that are driving both credit consumption, but also productivity and innovation. Yeah.
As we just heard Tom Lee discuss Bitcoin's potential for becoming the best performing asset this year. Now let's hear him elaborate on how AI is creating infinite opportunities through exponential technologies and why demographics are the ultimate driver of the next equity cycle. His perspective on reshaping productivity and the economic landscape is a must-hear for every savvy investor. Now let's listen to what Tom Lee has to say.
And then there's a contrast because, as you know, in the rest of the world actually has a depletion of population. And so that's creating the demand for AI workers, which is what the US tech companies are producing. So I think that this does feel like it's going to be a very bullish equity cycle ahead. And that's why we're constructive. And it's been a rough start for this year, but I think we're just sort of getting through some of the kinks and burning off some of the recent bullishness. People who are going to call the top in data center demand have never really experienced industrial cycles, right? Because the cycles actually are going to extend until return on invested capital is well past negative. And I would be very surprised if we're already reaching that saturation now, because we know that any model today would have improved capabilities if you improved computing power or capacity. So we aren't even experiencing the negative side of that utility yet. So I think that it actually would still argue that you need to be investing more capital. And I know, like when you look at percentage of GDP, I mean, look at what happened with China when direct private investment, it got to 40% of GDP. And that lasted years before you had overcapacity in China. So I don't know how we're even at saturation today in AI, but that's just in broad strokes. So I agree with you. I think there's still a big runway ahead. And so they're supplanting those dollars for capital dollars that become balance sheet assets. In a world of labor shortage, that means you have less OpEx because that's wages, but you'll have more balance sheet intensity because now you have a computer that you're operating. So I think in a world of labor shortage, balance sheet intensity will go up. So it makes sense that these companies are big spenders of CapEx now. But that does create another wave of innovation because cooling and power supply and uninterrupted power and all these become strategic advantages, which will create another wave of technology innovation. So I think that there's a lot of opportunity and waves of opportunity being created because of that change that you've just highlighted. And we've even seen it in the financial industry. The financial industry used to trade labor intensive, so had a lot of traders and people. And then they replaced all the traders with computers. But someone naively might have said, well, then financial companies' CapEx will go down because they already have computers trading for them. No, CapEx intensity and tech intensity of the banks has actually only gone up since then. So that arms race, without even AI, is consuming more dollars. And that's, of course, I think going to be the case with AI itself. I've got two simple analogies to share that I think we should be looking for in AI. So we just published a study looking at the wireless fiber boom and when the stocks peaked relative to capital spending. And many people, so let's say it was a 20-year CapEx cycle for fiber and wireless. The stocks relative to the broad market peaked 8 years into the cycle. So in other words, like halfway into the cycle, the market will suddenly say enough capital has flowed into the space that they're market performers. However, in that like now in retrospect, the 25-year look back, one industry in wireless pulled away from everything. Two did. The first one is the tower industry. It has produced better returns than handset, chips, carriers, spectrum owners, the towers, and it's, as you know, it's a boring business that grows in a unit with demand. The second, of course, was Apple came along, but in 2007, so 13 years into the industry and after the industry's stocks all peaked, Apple came in and essentially gobbled up the economics of the ecosystem. So I think that in AI, it'll pay to look for the tower equivalent and the next iOS that'll come out on top of everything. But I think the second thing that's going to be important is that you just described it. AI is infinite workers with PhD qualifications, and yet these super intelligent entities have to eat pizza. And what I mean by that is like the best performing stock in the last 25 years is Domino's Pizza because everybody has to eat. So if you could find the pizza of the AI worker, so that's not the infrastructure, it's what you have to feed the worker, that's another moneymaker. And I don't know what that is going to be.
To watch the full interview, check out the link in the description. Tom Lee shows us Bitcoin isn't just an investment, it's key to understanding the future of finance and the unstoppable rise of AI. Think about this. Will Bitcoin outperform traditional investments like stocks and gold? And how could AI reshape the way we invest and work? Thanks for watching Only the Savvy. If you liked this video, please subscribe, like, and share for more cutting-edge discussions about crypto and beyond.